CLIC Connect. I'm your host, Craig Sullivan. We're winding down our season. We've got a very special guest. And if you were at CLIC 5, you met him there. But before I bring him out, I would like to thank our production partners, the good people over at Radisson Hotels, the Americas, and Chicago Title, National Commercial Services Group, California. So we all heard the big news on Radisson, but give our friends Phil Hugh and the rest of the development team a call over there. And please call our friends over at Chicago Title, National Commercial Services Group. You want to get your deals closed on time? They're the group to call. So those real estate deals, especially right now, need to close on time. So with that out of the way, and thank you very much to both groups, I'd like to welcome Stephen OConnor, Managing Director and Principal, Robert+Douglas, Los Angeles. So, Stephen, welcome to the show. How are you, my friend?
I'm doing well, Craig. Pleasure to be here. Thank you for having me.
Oh, thank you. And thank you for the great job you did moderating our lending panel at CLIC 5 earlier this year. It was just outstanding.
Always a great time, and it was an exciting room to be a part of. A lot of great questions, and really the action in the corridors and people I met there was really time well spent. So thank you for the opportunity.
Thank you. I think there's something in the water between you and Rob Stiles. You guys are just absolutely amazing once you take that stage. I mean, you are anyhow, don't get me wrong, but you guys do a great job on stage. Thank you.
Well, yeah.
So with that, Stephen, would you do me a favor and please tell the audience about yourself and Robert+Douglas, please?
My pleasure. Thank you for the opportunity. I've been in the hospitality sector industry my entire career. I started washing dishes and bussing tables in restaurants. I wanted to be a restaurateur. And I went to Cornell's Hotel School as a graduate student, transitioned to hotel real estate finance. First job out of school was at HVS International as an appraiser. And then I joined Rob Stiles at Somblick Goldman Company in 2005. And I've been working with him ever since. We spent 5 years at Cushman & Wakefield when he and his partners sold the Somblick Goldman Company to Cushman. And then in January of 2013, we launched Robert+Douglas, and I was one of the founding partners based in Los Angeles. Rob's in San Francisco. Doug Hersher is in New York. And long friend and now partner in the firm, Evan Hurd, has opened our Nashville office. So we do mortgage brokerage, investment sales, and we raise joint venture equity, all exclusively in the hospitality sector. We've now going on in January will be our 10th year. So time flies when you're having fun and working with good people. And we're really excited to have established ourselves in this sector.
Absolutely. And you guys recently, I'm going to say in the past 30 days, had a pretty big closing too, didn't you?
Yes, we are, fortunate to have, the markets have been accommodating at least a year to date. And we've had a very good first quarter and into second quarter. We closed a really big sale in Aspen, but also of a resort in northern New Hampshire. We've got a bunch of debt deals done in Napa. We're about to go under contract on a financing in the desert. So we've had a good year to date, and now we're dealing with some market volatility. Still optimistic about how this entire year is going to shape up.
Yeah, I think we all have to be. If we're not, we need to be. What type of loans are you typically doing right now? Besides, I know you're doing acquisition, so let's start there and go the gambit of what you're doing, please.
Sure. We have a diversified practice, and we like to split our business between investment sales, mortgage brokerage, and raising JV equity, and then in the debt front, between development financing, bridge, and more permanent financing. Right now, we're in the market with a large bridge loan for an asset that's coming out of renovation and is ramping up, has a relatively low debt yield. The loan request is around $50 million. It's in a major Midwestern market. And we have a number of active bidders pursuing that opportunity. I'm also, as I said, we're signing up a deal in the California desert. That's an acquisition loan with a bridge lender as well. This is a brand that is looking to do pretty major renovation, and it's a boutique space. It's adaptive reuse of what we would consider a functionally obsolete exterior corridor motel. But I'm doing a pre-development, pre-construction bridge loan of land in the Valley, in the Woodland Hills submarket right now that we're closing on. And we also have a bunch of assets in the market for sale. So we have a good diversity of deals in the market. And, it helps because you never really know where there's liquidity at a given point in time. And we like to be, we have our fingers on the pulse of the totality of the market.
Absolutely. And I like that diversity. I think it makes you a stronger lender and it makes our industry stronger because you do have that diversity and everybody can call you and go, hey, look at, I need a bridge loan. I need this. I need that. And, move forward. Now, on your construction loans, typically, and we'll talk about interest rates in a little bit, but typically, how long has it been taking to get that closed, and what's typically the loan to cost that you're willing to lend on?
Sure. And to be absolutely clear, we're advisors. We don't lend or invest capital ourselves. We're mortgage brokers. So,
right.
The construction market is one where we tend to be selective on the deals that we take on because lenders themselves tend to be very conservative. And, we approach deals from the perspective that borrowers want non-recourse financing, where the only collateral for the loan is the asset itself and not, the guarantee and personal balance sheet of the borrower. Most construction deals today require some level of recourse. I say most. The lower leverage ones, perversely, require the recourse because they're likely coming from regional lenders, bank lenders, relationship lenders of a borrower. And we can help that borrower source a new relationship if their existing, go-to lender relationship is out of the market. And many are, unfortunately. Yeah. But then at the other end of the spectrum, there are higher yielding debt fund lenders and bridge lenders that will do construction. They're solving for a higher return on their invested, on their loan dollars. And frankly, a lot of those lenders will do non-recourse deals. So you're kind of trading off lower leverage, lower cost, and recourse, and higher leverage, higher cost, and frankly, non-recourse. Now, the time, if a borrower has everything teed up, and by everything, I mean construction drawings and a GMP in place, where they're truly ready to put a shovel in the ground, of course, you need to allow a period of packaging before we can take a deal to market, but we can market in 2 or 3 weeks. You negotiate term sheets over another week or two, and then you move into a closing and due diligence and then closing time frame, where that could take another 45 to 60 days. But start to finish, we could get a construction loan funded within a 3-month time frame if a borrower truly has everything ready to go.
Yeah. And I would also imagine with some of the guarantees, depending on the borrower, of course, and let's use my neighbor Bob Olson as an example. He's never been afraid to sign guarantees, but I want him to burn off as we hit certain milestones.
That's right.
So I'm sure that's part of the packaging or the part of the final deal as well. What are the interest rates at typically right now? Besides the raise that just happened, what have they been at in the past?
Sure. 30, 45, lower leverage deals, typically they get priced on a floating rate as a spread over SOFR, over 30-day SOFR, which is going to be moving with this rise in the Fed rate. And, in good times, at 50% leverage, that would be around 350 to 400 basis points over the base rate. I would say that as lenders have become more conservative and some have left the market, those that remain have been raising their rates. I think you should, even if you're providing a recourse guarantee, even if it's only 50% leverage, you're still looking at about a 400 spread over the base rate, which, is 5.5% money, given where spreads are going. And, but still, and yes, you're guaranteeing, but that will burn off first once you complete the construction. You have a certificate of occupancy, then some of the guarantee dissipates, and then it's tested on debt yield. As NOI ramps up, as the debt yield gets up, so that you are showing trailing history that's well in excess of the debt service, the guarantee can entirely burn off with some lenders. Others, they open up to a prepayment, and we, of course, would be happy to refinance into a more permanent financing.
There we go. I love it. So let's talk about the elephant in the room now, my friend.
Sure.
Interest rates went up.
Yes.
As an advisor, working with lenders, borrowers, what's that conversation like that you're just starting to have?
Yes. This year has been a one of in transition, where we saw the potential for inflation and rising interest rates as the forward rate curve was playing that out for a while. But so in my entire career to date, a lot of people have made a lot of money by betting against that forward curve. This is one time where the forward curve has actually been conservative. That rates have in fact been rising more aggressively than what was projected in the derivative market. So people aren't seeing so much a curve as they're running into a wall of rising interest rates. And we're hearing from a lot of high leverage lenders that they require senior financing, or either in the repo markets or with the line of credit from a single or a consortium of banks, the big money center banks. And that market, the most low leverage, the most conservative, and also the most insulated and protected position in the capital stack, those lenders are pulling back. And that has a ripple effect all the way through the market. And higher leverage lenders have to, at a minimum, raise their rates in order to deliver that full stack execution that everyone is hoping to achieve. But also some groups are being sidelined. So, but that said, there's still, this is very different from the COVID induced crisis 2 years ago, when the entire world and the market went into lockdown. There is still a very low unemployment rate. It might be rising, but still we have it's both cost push, but also demand pull. High demand is driving inflation today. And, so long as the consumer continues spending, so long as corporate travel continues to recover, there's going to be good liquidity in this market. And so we are still seeing multiple bids on every deal that we take to market. It's just that the terms are shifting for sure.
Yeah, absolutely. And, I think, and please correct me if I'm wrong, but, granted, rates, occupancy are, coming back or are back to pre-pandemic levels in some markets, not all. We've still got problems with some urban core. San Francisco, downtown LA, New York still have a lot of hotels that are closed. But I think part of the problem that we're going to see, and again, correct me if I'm wrong, you've got people that burned through their CapEx money that was held. You've got people that went into forbearance, and those payments have to be made. The lenders are looking at that, and you've got a loan due this year or next. Isn't that adding a lot of additional pressure on that asset? And could that possibly be leaving the market and coming back in the form of multifamily or something else at this point?
There's a lot in there to unpack, but I'll try to address as much of it as I can, or we can break it up. During the pandemic, anyone that had debt that was coming due could go to their lender and would likely be well received to get extensions, forbearance on debt, covenants waived. So if there was already additional term built into their loan, but subject to reaching certain milestones, they likely were waived on through and given additional time. Now then we had a year of recovery. Not that the pandemic has gone away, but that people have been adjusting to this new reality. And for that matter, leisure-driven and select service assets had some of their best years, and there were record trades, and a lot of deals were done, and a new sort of post onset of the COVID benchmark was set in a lot of markets, and so people were able to mark their positions to market. And so now, if we're going into a period of some market dislocation, of choppiness, however you want to characterize it, where it's more difficult to access capital, but not impossible, it remains to be seen just how accommodative lenders are going to be, especially if it means extending a borrower beyond the anticipated term of a loan. It's one thing to give free covenant waivers. It's another thing to go beyond the term. And it's especially another thing to go beyond the term of a loan when they see that there have been trades, granted maybe 3, 4, 6 months ago, that would imply a value in excess of the loan amount. We don't yet know how accommodative lenders and special servicers are going to be when borrowers come hat in hand, especially when there is liquidity in the market. It's just not on terms that you might be so pleased about.
Yeah, no, I think that's a very, very target, statement that you've made right now. And I think you're right about that. I think, you look at what some of the assets are trading for here in California, there is liquidity in the market. There's value there. I may not, as a lender, I may not be inclined to, give you more time on that. But, if you've been forthright and we've worked through the pandemic, I might be able to, do a refinance with you. And again, that term's going to be something you're going to have to adjust to in today's market, I think.
Lenders want to see that borrowers are committed to their asset. And
right.
the way that that is demonstrated to a lender is by writing a check and paying down the loan, at least marginally. You have to show them something. It's so free extensions without a right sizing of a loan are going to be hard to come by. And you touched on the desirability of California real estate in particular, and there is so much equity. So yes, debt markets are a little skittish and becoming conservative, and equity investors, of course, would love to find opportunistic investment opportunities. But there is so much equity raised sitting on the sidelines waiting to be deployed. It'll be interesting to see what truly happens to asset valuations. A little bit of a game of people playing chicken here, because yes, maybe they'll hold out for an opportunistic or distressed deal, but you also could just do nothing and miss the time to deploy capital into a market where at least you can get trades done. I do believe that owners will have a greater appreciation of buyers, and that that the bid-ask spread should narrow, and in a competitive process with so much capital waiting to be deployed. Everyone has different leverage requirements and strategies. There are all cash buyers, there are low leverage buyers, there are institutional buyers that have so much capital to deploy. Yeah, groups that require cheap and high leverage financing, they might be at a competitive disadvantage. But there is, especially for trophy assets, anything within the first 10 miles of the coast, anything in coastal California, forget about it. It's all day long and twice on Sunday. There's liquidity for those assets.
Absolutely. I mean, you look at, Terranea, Montage, and some of the, Dell down in San Diego, just classic hotels that we've got along our coastline are just amazing. Yeah. Bridge financing, what's that like right now for you?
So bridge financing, these are lenders that they're lending into a story, a value-add story, whether it's change of management, a ramp up due to renovation, change in branding. There's always a story associated with the bridge loan, and bridge lenders they get paid marginally more than permanent lenders, and and they're not so much lending into cash flow as they are lending into the business plan. And so strength of the borrower and a lender getting comfortable at their last dollar of exposure to a loan is really important. But it's not so much the going in LTV, the going in debt yield and cash flows that are in place that matter so much as, looking 2, 3, 4 years out into the future. And, what do they think the asset's going to be worth in the future to give them confidence that that a borrower will be able to pay them off. So bridge lenders finance business plans and they get paid marginally more for it. But now is the time for bridge lenders to shine because the market really needs their capital. And I do think there's going to be a lot of trades where people don't have the cash flow in place to put permanent debt in place. They're going to need bridge lenders, and so some bridge lenders require that senior financing of their piece, right? They're solving for a mezzanine loan that they hold on book. Those bridge lenders are going to be less competitive in the market. But I've been talking with a couple of bridge lenders today who don't require any leverage, that don't require a repo facility, and I am telling them now is the time, take a contrarian position, go all in. You're going to make some of the best loans, at this point of uncertainty in the market. And again, there is most definitely liquidity. I just think there's going to be a renewed appreciation of capital and what it solves for borrowers.
I agree with you. Now, before we get into our lightning round, my friend, what excites you about the California hotel market right now?
I don't know. It's the weather is always great, and and I guess you can count on the politics to remain as dysfunctional as they are, so that you always have support of high barriers to entry. Everything is high barriers to entry because it's impossible to build. So that sets the stage for the existing assets and anything that can get entitled to be appreciated as being valuable and potentially, more valuable than what it costs to actually build. You have, that the equity in these assets is rock solid. So, to the extent that there are opportunities for for investors to acquire assets at attractive valuations, that would be that's the opportunity to jump on. But from my perspective, there's always a bid, there's always liquidity, and it's nice to know that as someone who's facilitating transactions, that that you can always get something done in California.
Absolutely. All right, my friend, are you ready for our lightning round?
I can't wait. I've heard so much about it.
Okay. Producer Danny's going to put 2 minutes on the clock starting now. Cap rates.
Going up.
Team.
Golden State Warriors.
Third-party reports.
Long lead time is the appraisal.
Fast funding.
Hard money lenders.
Interest rates.
Spreads compressing, but rates going up.
Uber or rental car?
Taxi or rental car.
There you go.
We're short on
Favorite
Uber.
airport?
LAX.
Aisle or window seat?
We call it redneck first class, aisle in the exit row.
Tequila or whiskey?
Bourbon.
There you go. Favorite hotel or resort?
The Hanamaui Resort, which is now destination
Nice.
in Hawaii.
Nice. You did that in 56 seconds left, my friend. Congratulations.
Fantastic.
So, the Hana Resort in Hawaii. Love that hotel.
It's my favorite.
Love that. When's the last time you were there?
Well, we were planning to go in the summer of 2020. Had to cancel that trip due to COVID restrictions. The window reopened. We went back last August, but we were thinking about booking again. We're not quite planning as far, in the future for our, we're sending our kids off to camp, and we're thinking about doing a family trip in August when they're back before school starts. But we're shortening our booking window. We'll play it by ear, see how the summer goes, deciding whether to make that incremental family trip or not. But I would love to go back this summer. It's my favorite place.
There you go. Producer Danny's got a family trip coming this summer, so she's on her way over there for a week or 10 days, something like that. So with everything that's going on, and how many deals are you guys typically closing in a quarter?
We have 15 to 25 deals in the market at any given point in time. I wish it was so steady, though, because they all tend to lump together. I think we closed at least a half dozen deals in the first quarter. I think in this second quarter, we're to a handful, 4 or 5. So in a good year, we'll close 20 deals. That's a good outcome.
I love it. Congratulations.
Thank you.
Stephen, we are out of time. So how about a shameless plug? How can people get a hold of you?
Shameless plug. Well, I mean, look, in this market, people pick up the phone to their relationship lender, their go-to lender for so long. They very well might tell them that you're out of luck, or that they're taking a more conservative approach to their lending. And I am here to tell you that there most definitely is liquidity in the market. And this is what we do all day, every day, is talking to lenders with every type of financing request, as well as investment sales and raise JV equity. The good thing about our firm, you hire one of us, you get all of us. All of our, it's not as apparent from the outside looking in, but we are not, pure play commission brokers. We call ourselves investment bankers because it's all for one and one for all at Robert Douglas. We have offices on a national basis. We work on a national basis, and pick up the phone. I answer on the first ring, and look forward to speaking with you and any of your listeners at any time.
There you go. You want to give them a website or an email or anything?
Sure. The website is www.robert-douglas.com. And that's our email address as well. First initial, last name. I'm Stephen OConnor, SOCONNOR at robert-douglas.com. Don't hesitate to reach out.
Stephen, thank you for joining us today. You've got an open invitation to come back anytime you want.
I can't wait. I really appreciate the opportunity, Craig. Thank you.
Please make sure that producer Danny and I get your press releases so that we can put them out on our blog and social network for you guys as well.
We will not.
Stephen's absolutely amazing, as is the team at Robert Douglas, and I really encourage you to give them a call. I don't know a single hotel owner that isn't looking for additional sources of funds. Okay? Give these guys a call. It'll be a great experience for you. Stephen, thank you.
Thank you, Craig. Really appreciate it.
Take care. Thank you, our audience. We're just about done with season 6. We've got 2, maybe 3 more shows. So we're going to be wrapping this season up. We're going to take a little bit of break. We're going to make some announcements about CLIC 6 coming up soon. And all types of other things are happening as well. So, but with that, I do want to thank our production partners one more time, our good friends at Radisson. Give Phil Hugh and his team a call. Also, give Lance Capel over at Chicago Title a call. He heads the National Commercial Services Group here in California, and they're great. They work all over the country, and he'd love to hear from you. And make sure you tell them both that producer Danny and I sent you there. They'd love to hear from you. So thank you for joining us today. We've had an incredible season. Wouldn't be possible without you guys, and I thank you, and so does producer Danny. So with that, remember, be kind, share your knowledge. Now go be amazing.